Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Michael Oliver. We have a little more time with Michael today, so I'm really hoping to take advantage of that. And also like to, as always, tell you to go to olivermsa.com, olivermsa.com, to learn more about Michael's work and hopefully to sign up for some of the excellent advice that he provides, because what you hear on this show is just a smidgen of what Michael has to offer. And he talks most often and mostly about gold and silver and related markets, but he covers a huge number of markets that are of benefit, can be of benefit, or are of benefit to subscribers, not only to be on the long side, but sometimes just to stay out of those markets and avoid getting burnt. Michael, thanks for joining me again.
Good to be back, Jay.
Always good to have you with me. And, one of the things that you like to look at is relative markets, relative movements of one market with another. For example, you like to look at the S&P and gold. I know that's one thing you like to look at. What are you seeing in that relationship, and what do you think we are likely to see going forward through the end of this year, perhaps?
Well, I think the interrelationship between asset categories is very strong, either inversely or, coincident. But in the case of the S&P, let's call it developed stock markets, be Japan,
yes,
Europe, us. Obviously, U.S. is stronger than either of those two, if you look at the charts, for example, over the last 10 years. But that might imply that we got more downside to go once it gets rolling. But the one thing about the S&P, I think that's happened that the charts don't tell you, the price charts don't, because you're at a new high again, is that somebody's doubting it. Because money's flowing out, that's clear. It's been moving into the T-bond market, T-note market, not into high yield. It's been moving into gold. And we've had some major name hedge fund and fund managers around the world who are not gold-oriented necessarily, but are now, and have made statements to the effect that, we think gold is a place to be, gold miners are a place to be, and they haven't, that's not their tune, and yet they recognize it. So I think there is a seepage of capital out of the stock market. And I have a sense that even without measuring via momentum, which we do, and we try to do it precisely, that the longs are going to get really frustrated and bent out of shape here if this thing doesn't get traction soon. And what I mean by traction is we made a high in January 2018 in the very upper 2800s, and then we had a sharp drop. And then you came back in September of 2018, and you got up to 2940 and had a sharp drop. So you made a new high by a couple percent and fell apart. So the new high wasn't a buy. In fact, it was a sell, okay? Then you came back up again here, and you got a high in April at 2950 and had a sharp drop. And now you've come back up again, and you've tagged 3,000 finally, and nothing's happened. It's been 3 weeks of absolute boredom with lows in the mid-2970s and the high was 3017. So you're stuck in a 1.5% range for 3 weeks. One of these new highs better get traction and take off, because I think the longs are going to get frustrated and see what's going on pretty soon, that, hey, every time we make a new high, we don't go anywhere. We go down. And I don't think they can take another down. If they get another down, it's our view, and we've got very specific numbers, and they're not right under your feet, but they're not too far away. So, for example, Morgan Stanley recently badmouthed the stock market. I think Wells Fargo did, Blackstone Group did. Quite a few names are saying, hey, we're doubters up here. Now, some of them aren't claiming it's a bear market to come, but they're claiming you need a big correction. Well, MSA will state definitively you cannot have a correction, meaning you can't get a double-digit drop of 10 or so percent, because if you do, our work says you're going off the page. You're going to drop another 30 to 40% rapidly. We've got trigger numbers below that tell us that you cannot afford a 10% pullback, as much as many people might like to buy that. So the question then is, if there's already been seepage of capital out of the equity markets into other asset categories, will that spark massive outflow? And I think it will. And I think gold is already one of the beneficiaries, if not the prime beneficiary of that. Just look at a gold chart. And so anybody in the gold market should be watching the S&P, is my view. Don't be so preoccupied with every $10 downtick in gold.
Yeah. Well, so people probably feel like they're spinning their wheels up here, and you're seeing this, what looks to me, Michael, like a gigantic topping process. Would you agree with that on the U.S. markets?
Yeah, the S&P.
I mean, we've seen those before, of course, at key places.
This is one of the biggest I've ever seen. Also, the structure below the market, meaning if you looked at our annual momentum charts of the S&P, which don't look anything like looking at a monthly price chart of the S&P going back to 2009, which is just an uptrend. But the momentum charts, annual momentum, it's a flat structure. And it looks like a bridge where, each of the pontoons is the same distance and it's a flat bridge. And we can define the structure very clearly, which if it breaks, we're going to get a collapse. And that structure, like I said, is right now about 10% below the market. By later in the year, it'll be about 6% below where you are right now. So you cannot afford to sneeze. They must get traction. We don't think they're going to get traction. But we want to wait for the numbers, no sense guessing. But I think when that happens, that will lead to more gushing of money into gold. Yeah. It's one of the few areas in the world that is behaving well. Most commodities are still flat. This Bloomberg Commodity Index has been sideways in a range since 2016. You're in the middle of that range right now. So it's not the commodity category that's starring, but it's only government bonds, which means safety, at least perceived to be safety, and gold. And,
So, Michael, what you're saying is, a 10%, that's sort of what people think. Oh, we can get upwards to a 10%. That's a correction. No harm done there. I mean, that's just a normal exhaling, inhaling exercise. But what you're saying is that kind of a very minor 8-10% or so is going to cause the whole thing to collapse, and then we get 30 or 40%. And what do you call that? That's more than a correction. What's your terminology?
I call that the first wave of a bear market. If you go back and study stock market bear trends, either begin with a crash or they end with it. 2008, for example, we peaked in 2007, started down in 2008, but it was irregular, zigzagging. You didn't really have your crash effect until October 2008. 1929 was a different story. You crashed at the beginning, and then you had a big rally halfway back to the high, and then you rolled over and went down bleeding for 2 years, slowly. So, stocks tend to either begin with one or end with one. We think because of the momentum trend structures that we can define clearly, and if you saw the charts, your jaw would drop because you don't see it on the price chart. Says, no, if we go down, we're going to start with a crash. And then you'll probably have a big rally, and then you'll probably go into some slow-motion grind for a year or two. But it will definitely cause a sudden movement of capital out of the stock market that has not maybe been dislodged to this point. And I think it'll be dramatic. And I think the debate that we have between, the guys who are skeptical of the stock market and those who are always long forever thing, will end almost overnight. If we go to our numbers, I think that the debate will just about end within 48 hours of hitting that level. This is we've stated this before, and we state it again. It is the worst annual momentum structure, long-term momentum structure in the stock market in 100 years. The issue is to get down to it and trigger it.
Yeah. So really, what we're looking at is not a correction. We're looking at something that's very severe and potentially very severe. Is what you're suggesting?
Yes, I think so. Meanwhile, if you like to own stocks, call gold miners.
Gold stocks and silver stocks too, Michael.
Yeah.
Silver stocks are looking really good.
For example, if you went back to March, April, GDX was laying. The GDX is the gold miner ETF, the majors. Was laying between 20 and 21, just dead. No volatility, no movement. It was almost like, what's going on here? And when it broke out at the end of May, it went up to 21. It shot to 24 in a heartbeat, and then it shot up again. We're now at 28, and it's July. So how many weeks is that? We've gone from 20 to 28. Look at the percentages. Quite a move, and in a matter of weeks. And we think that the GDX, before it gets a pause, is probably going to at least see something in the low 30s. Silver last week contributed in a big way. It had been a dog for the last couple of years relative to gold. And we had a cluster of numbers that weren't price-based or momentum-based. Between 1580 and 1605 was our highest trigger number. And we've shot up to 1650. We traded over 1650 again today. We're just barely above the last breakout number, so it's not a place to have a correction. You're still just in launch mode. But silver is joined in now. So, and it's catching up to gold, and I think it'll continue to outpace gold going forward from this point forward. We think the backbone of that anemic period for silver is over. We think it's broken, and we're now headed up on a relative basis, and the same with the gold miners. Still have to watch gold, though, because... Yeah.
So Michael, you're not buying the notion, because I've heard a lot of chatter about people thinking that we should have a pullback here in gold. It's going too fast. You're suggesting not so until what sort of?
No, it doesn't make sense, because we just achieved certain breakout levels. Now, admittedly, they're secondary breakout levels. The first buy for gold, according to our work, was in February 2016, just above 1140. But there was another big shelf of annual momentum we took out in June. We just took it out then, so it's fresh. Silver just broke out over a 3-year wide quarterly momentum base when it touched 1605. Well, you're trading 1640s right now. Is that an excessive run after that breakout? No. Now, you get up around 18 to 20, you might get a little more cautious, but we see no particular reason to expect a sharp correction here. Instead, what we've had over the last couple weeks is just tight congestion. No sharp pullbacks. And I think that's about all you're going to get.
Well, all I can say is it's doing wonders. All I can say is it's doing wonders for the silver stocks, Michael. Breaking out like crazy, and I felt that I had to find some cash from some source, and I had to sell some things I didn't really want to sell to make sure my silver exposure was a little bigger once I saw your charts showing the breakout in the silver. And like you say, your jaws would drop. Very often the case. When you look at Michael's momentum charts, they're quite a bit different than the price charts, which is what everybody's looking at. And Michael, so often I've found your charts to be prescient and much ahead, allowing people to see what's coming so that they're not blindsided. I think that's one of the most valuable things that you have to offer is your ability to foretell using momentum, what is heading in our direction. So just with about a minute left here yet, your outlook for the dollar and for T-bonds.
Dollar is still boring as can be. It hit in a big, strong rally in August of last year when it made a high at 97 after having rallied from the 88 level, this dollar index now. And we're trading above 97 right now. So it's 11 months later, and it's yawning. Yet everybody says how strong the dollar is. If you even just look at the dollar index chart, it's a horizontal situation where you've been 1% or so either side of 97 for 11 months. It is the most quiet dollar situation I've seen in many years. One area in the foreign exchange market that's not quiet, and most people are missing it, is the emerging market currencies are quite strong relative to the dollar and have been since last August. So while the dollar has gone sideways versus, let's say, the euro or the pound or the yen for the last 11 months, it has not gone sideways versus emerging market currencies. It's gone down noticeably.
Interesting.
So
that's very interesting. And Michael, last week we had Jim Rickards on the show, and he talked about the breakdown between the Chinese currency. I don't know if you follow that or not, and the or the correlation, I should say, between the Chinese currency and the SDRs, whereas the dollar and gold has broken down. So, the normal correlation. So, very interesting things.
We expect the dollar will break down versus the dollar index, which is heavily weighted by the euro. And I think it will break down soon, but it hasn't triggered our final signal numbers yet. They're not far below the market, but we need to see those numbers broken, and then we'll see the dollar index wake up, meaning wake down. And that'll likely help gold, too. But the dollar steadiness over the last 11 months has not at all impaired gold, because over the same time period, August last year, we went from 1160s up to a high recently of 1450 without any weakness in the dollar.
Yeah,
none.
Exactly.
So,
yeah, very interesting. All right, we'll have to leave it go at that, Michael. Thank you so much for your time and sharing your wisdom with our listeners, and we'll look to do it again next week. Thanks so much.